Thank you for joining us at XM.com for today's market comment by Rafi Boyadjian. I'm Maria Bashirdiz. Expectations of further tightening by the Fed diminished further on Wednesday after more data pointed to a slowing economy in the United States. Hot on the heels of Tuesday's unexpected drops in job openings and a key gauge of consumer confidence, the ADP employment report, also disappointed yesterday, fueling speculation that Friday's non-farm payrolls print will also fall short of estimates. The focus on Thursday, however, will be on the core PCE price index, which the Fed tracks for its inflation objective. Whilst the data that's come out so far this week has cast doubt on just how resilient the U.S. economy really is, today's releases could have the opposite effect. The core PCE price index is expected to have edged up to 4.2% year over year in July from 4.1%. After the market probability for one final rate hike from the Fed shot up after Powell's Jackson Hole speech, those odds have now been mostly reversed. This abrupt swing in market pricing has put a halt to the rally in both Treasury yields and the U.S. dollar. Wall Street, on the other hand, reacted positively to the not-so-strong data as investors grew more confident that the Fed will pause in September and start cutting rates as early as May next year. Of course, much will depend on which way today's and tomorrow's releases go, but the upbeat mood is holding for now. Asian equities were mixed, however, as lingering concerns about China's economy pulled Chinese and Hong Kong shares lower, despite Beijing stepping up its support for the troubled property sector. However, the stimulus headlines were overshadowed by a warning from China's largest property developer, Country Garden, that it faces the risk of defaulting. PMI data for August brought more gloom as the manufacturing sector continued to shrink. The euro slid on Thursday, reversing some of this week's impressive gains. Headline inflation was unchanged at 5.3% year over year across the euro area in August, versus expectations that it would fall to 5.1%. It follows similarly strong figures out of Germany on Wednesday, which boosted the odds that the ECB will hike rates again in September. However, traders seem to be reassured by the surprise drop in one of the underlying measures and are taking that as a sign that Eurozone inflation will resume its downward path in the coming months. Thanks for watching today's market comment here at XM.com.